Every trader's journey begins with a spark, that first flicker of curiosity that draws you to the market. It might start with a YouTube video, a friend's success story, a blog post about someone turning 500 into 10,000, or a chart that suddenly seems to tell a story you've never noticed before. That initial spark is electric, magnetic, almost intoxicating. You feel like the universe is giving you a secret, a map to hidden wealth. In this stage, your mind is full of ideas, possibilities, and dreams. You imagine yourself making perfect trades, beating the market, and finally achieving the freedom that has always seemed just out of reach. You feel unstoppable because everything looks simple on paper. You read about candlestick patterns, Fibonacci retracements, trend lines, and moving averages, and for a moment, you believe that knowledge alone is the key. The charts whisper promises, and you are eager to listen. You sign up for a demo account, or perhaps you risk a small amount of real money, thinking, I just need to prove it works. The first trades are thrilling. Even if you lose, you're not discouraged, you're learning. Every win feeds your ego, every loss feeds your hunger for mastery. You feel alive in a way nothing else has ever given you. The ignition stage is pure energy, pure enthusiasm, untempered by reality. Your mind is sharp, open, and curious, absorbing every tip, trick, or strategy you can find. You're experimenting, testing different indicators, reading forums, joining social media groups, watching every trading video, and taking notes like a scholar preparing for a final exam. You are fully convinced that if you just put in the effort, the market will reveal itself to you. There's a dangerous beauty in this stage because it's seductive. It makes you believe that skill and knowledge are all you need. You think that if you can just master this chart pattern or that setup, your account will grow overnight. The truth is, the ignition stage is less about winning money and more about awakening your obsession. You are not yet a trader, you are an explorer, and the charts are a landscape you are discovering for the first time. Your mind is a sponge, soaking in everything, trying to understand a system that is far more complex than it initially appears. At this point, discipline is almost irrelevant. The excitement of learning, the thrill of placing a trade, and the dopamine hit of seeing a small win are enough to keep you motivated. Every trade feels like a step toward validation. You're not chasing profits yet. You're chasing the feeling of possibility. However, the ignition stage is also the stage where illusions form. You begin to confuse knowledge with skill, observation with mastery, and hope with certainty. You may read about risk management, stop losses, and position sizing, but your brain is wired for excitement, not prudence. The first few profitable trades create a powerful chemical reaction in your mind. Dopamine floods your system, reinforcing behavior that feels like success. You start believing in your own intuition. You see patterns everywhere, often where none exist. This is where overconfidence silently starts to creep in. It is subtle, almost invisible, because you feel justified. After all, you've been reading, studying, and applying yourself. You deserve to feel confident. But the market doesn't care about your study hours. It doesn't reward hope or enthusiasm. It doesn't care if you are disciplined or reckless at this point. It only responds to probability and execution. The ignition stage is a crucial foundation, but it is also treacherous. Many traders get stuck here. They accumulate knowledge endlessly without ever testing themselves under real pressure. They are content to read, watch, and learn, mistaking information for progress. They may even make small profits, but the real test, consistency, has not yet arrived. The market at this stage is like a mirror reflecting your untrained mind. Every impulsive trade, every moment of hesitation, every emotional reaction exposes weaknesses you haven't yet learned to control. Yet in this stage, failure is invisible. You don't yet feel the real consequences of emotional trading because your positions are small, your risks limited, and the stakes low. This is why the ignition stage is both exhilarating and dangerous. It creates the hunger for mastery but hides the true cost of trading reality. Your first real test comes when you begin to trade larger sizes or real accounts. The same excitement that once motivated you now turns into pressure. The stakes are no longer hypothetical. You realize that every trade has consequences and every mistake can hurt your account. Here, the ignition stage begins to transition into its next phase, the reality stage, but the seed of discipline is planted here. If you can harness the energy, curiosity, and hunger from this stage and combine it with structure, rules, and patience, you begin to build the mental scaffolding needed to survive the next challenges. The ignition stage is more than just excitement. It is your proving ground for mental endurance. It's where you learn to face uncertainty without being paralyzed, to take action without overthinking, and to feel the market without being consumed by it. It is the first layer of emotional training, even if you don't recognize it yet. The key takeaway of the ignition stage is simple: energy without direction can burn out, but energy with focus becomes unstoppable. You must learn to channel enthusiasm into disciplined action. You must learn to see that your first few wins are not validation of skill, but a chance to observe your reactions. Are you calm when trades move against you? Are you patient when setups don't appear? Do you stick to your plan, or do you chase opportunity? These questions, though uncomfortable, are the first test of your emotional resilience. The ignition stage ends when curiosity meets reality. When you realize that the charts are not a teacher but a test, that learning is never complete, and that true mastery is built in the moments where your emotions conflict with logic. If you can navigate this stage successfully, you emerge with a heightened awareness of yourself, your strengths, your weaknesses, and your potential. You've felt the thrill of possibility and the pangs of frustration. You've seen both the seductive allure of success and the hidden dangers of overconfidence. You've tasted the chemical reward of dopamine from small wins and begun to understand how easily it can hijack your decisions. This understanding is invaluable. Without it, the next stages of trading, the reality stage, the emotional valley, the discipline forge, and ultimately mastery, will be exponentially harder. The ignition stage is not about profit, it's about awakening your mind, calibrating your emotions, and building the mental fuel necessary for the grueling journey ahead. It is the stage that separates dreamers from future achievers. Traders who understand the power of this phase don't chase every signal or obsess over every setup. They watch, they learn, and they prepare. They know that the real journey is not about making money quickly, but about training themselves to survive, adapt, and grow under pressure. They know that the market will test them mercilessly, and the only weapon that matters is self-awareness. In essence, the ignition stage is the first building block of trading psychology. It is the spark that lights the fire, but it is also the stage where many falter, distracted by the promise of easy profit or blinded by the thrill of small wins. The traders who last are the ones who see beyond the short-term excitement, who understand that every emotional reaction, every impulsive urge, every moment of doubt is data, feedback on their inner state. They learn to observe without acting, to feel without reacting, and to dream without attachment to outcome. The ignition stage is where the mind of the trader begins to form. It is where curiosity becomes discipline, observation becomes insight, and potential becomes preparation. It is raw, intense, and exhilarating. But most importantly, it is the stage where the foundation for every future success is quietly, invisibly laid. Without mastering this stage, the later phases, where real money, real stress, and real mastery meet, will collapse. But with awareness, focus, and reflection, the ignition stage becomes the launch pad for everything that follows. The spark ignites, the fire begins, and the journey, the true journey, starts here. Every trader's first real challenge is not the market itself, it's facing the mirror of their own mind. Once curiosity draws you in and excitement fuels your first few trades, the illusion of control begins to creep in. Suddenly, the charts aren't just patterns of numbers, they are riddles that seem to whisper secrets to you, secrets that only you can decode. You feel like you've discovered a hidden world, a puzzle of price action, candlesticks, and momentum that promises wealth if only you can solve it. But the truth is harsher. This is where the first real stage of growth begins, the stage I call the illusion of control. In this phase, you know enough to see possibilities, but not enough to understand the full depth of what's required. You think skill alone can bring consistency, but the market doesn't reward knowledge, it rewards execution and restraint. Every novice trader believes they can outsmart the charts, but the market is neutral. It doesn't bend to your will, your hopes, or your ego. It only reflects back on your decisions and your discipline. At this point, the first few wins feel intoxicating. The dopamine rush from a profitable trade convinces you that success is predictable, that victory is repeatable, that you are capable of mastering the market with sheer intelligence. You tell yourself, "I've got this. I understand it now." That thought is dangerous. That moment of overconfidence is where many traders begin their descent. This is the subtle trap of the second stage, overconfidence and emotional amplification. You start to believe your system is flawless, your gut instinct infallible. One trade feels like proof, two trades like validation, and soon you are chasing a third, fourth, and fifth just to satisfy the feeling of being right. Each trade reinforces the dopamine loop. Your brain begins associating the thrill of profit with self-worth, not strategy. You are no longer trading to test setups or follow rules. You are trading to validate yourself. This is the phase where greed disguises itself as skill. It doesn't roar, it whispers. Just one more trade, it says. You're on a roll. Don't miss out. And with each whisper, the boundary between ambition and obsession blurs. You start breaking your rules subtly. Stops are moved, position size is increased, patience ignored. Your rationale is flawless in your mind. You justify every impulsive action with reasoning that feels rational. The trend is strong. This setup looks good. I just need to make back what I lost. But beneath that reasoning is fear, fear of missing out, fear of inadequacy, fear that your knowledge is meaningless unless it immediately produces results. This stage tests more than your strategy, it tests your self-awareness. You begin to notice that winning streaks feel more addictive than losing streaks feel painful. Wins feed ego, losses feed reflection. But reflection is uncomfortable, so it is avoided. This is why traders overtrade after success. The brain doesn't crave profit, it craves the sensation of being right. Every impulsive trade is a symptom of dopamine hijacking. The market doesn't punish luck or reward bravado, it exposes the cracks in mental control. Here, education alone is powerless. Technical knowledge cannot restrain impulse, only self-discipline can. The crucial realization in this stage is that consistency is a product of emotional mastery, not intelligence. You need to observe the patterns in your behavior as diligently as the patterns in the charts. Every impulsive trade, every skipped rule, every rushed exit is a data point. These are not failures, they are feedback, and the trader who survives this stage is the one who learns to pause, breathe, and question, am I trading my plan or my ego? Every professional trader you admire has faced this. They did not skip over the overconfidence stage. They did not bypass the emotional surges that accompany early wins. Instead, they faced it, mapped it, and developed rituals to interrupt it. Some use journaling, writing down feelings after every trade. Some use timeouts, stepping away from the screen after a win or loss. Others strictly enforce daily stop limits and profit caps to prevent impulsive escalation. The tools vary, but the principle is the same: awareness creates control. Control cannot be imposed externally, it must be built internally. By the end of this stage, the trader begins to recognize a critical truth: the market does not care about their ego. Profits and losses are not validation or failure. They are neutral reflections of decisions made. Emotional detachment begins to develop. This is the foundation for the next stage, the emotional valley, where losses no longer feel like personal attacks and wins no longer inflate pride. But before reaching that point, the second stage exposes every hidden bias in the mind. Confirmation bias makes you see only the signs that support your desired trade. The illusion of control convinces you that your prior success guarantees future victory. Sunk cost fallacy tempts you to hold losing trades because I've already invested too much. These cognitive distortions are invisible traps, silently shaping decisions and undermining discipline. The brain is chemically primed to reward risk when it has previously been rewarded. That is why overconfidence feels good and loss aversion feels punishing. The trader must learn to separate feelings from decisions, to act not from desire but from protocol. This stage is also where the market begins to feel personal. You may notice your heart racing during volatility, your palms sweating when price approaches a key level, your mind rushing with what-ifs before every trade. These physical and emotional responses are your internal signals. They are indicators of discipline, not market direction. Learning to read and manage them is as critical as reading candlesticks. Professional traders know that the hardest opponent is within themselves. Mastering these responses is the gateway to resilience. If you fail here, greed and fear compound. If you succeed, you gain the ability to execute regardless of emotional pressure, a skill far more valuable than any technical edge. By the end of this phase, the trader develops a new perspective. Trades are events, not validations. Wins do not define worth, losses do not define failure. You begin to realize that the journey is measured not by the scoreboard, but by adherence to process. This shift in mindset transforms how every subsequent stage is experienced. You become less reactive, less anxious, less prone to ego-driven decisions. The market may still be volatile, unpredictable, and challenging, but your internal state has gained stability. You can now view opportunities clearly, without attachment, without desperation. The second stage is exhausting, not because of the market's difficulty, but because it forces confrontation with the self. It demands introspection, patience, and relentless honesty. Few traders survive it intact, yet survival here is pivotal. Without this stage, the subsequent stages, emotional endurance, strategic patience, and mastery, cannot be fully realized. Your edge is no longer your system or your charting ability, it is your ability to observe yourself, regulate impulses, and respond with clarity. This stage is also deceptively quiet in terms of outward progress. Your account may not show gains, your strategies may not yield immediate results, and others may seem to advance faster. But internally, you are rewiring neural pathways. Every resisted impulse, every disciplined choice, every deliberate pause strengthens the mental framework required for long-term success. By the time a trader emerges from this stage, the experience has fundamentally altered perception. Price movements that once provoked anxiety now register as neutral events. Opportunities that once caused FOMO now invite patient evaluation. The trader begins to anticipate volatility calmly and accepts loss as an integral part of the process. This is the invisible, yet profound, transformation, the shift from reactive to reflective trading. Here, traders begin to see patterns not just in price, but in behavior, both their own and others. They develop empathy for struggling traders, awareness of common pitfalls, and a strategic mindset that prioritizes consistency over excitement. Stage 2, therefore, is the crucible where overconfidence is tested, impulses are challenged, and emotional intelligence begins to form. Success is not measured in pips or profits, but in mental control. Once this stage is mastered, the trader is ready to enter the next phase, the emotional valley, where losses, setbacks, and uncertainty are faced without panic, and real skill starts to compound. Understanding this stage is crucial because it explains why so many traders fail early. Not because they lack strategy, but because they lack mastery over themselves. Knowledge is powerless without discipline. Intelligence is ineffective without patience. Experience is wasted without emotional control. The lessons from stage 2 are subtle, but essential. Winning streaks are dangerous. Impulsive trades are misleading. Emotional highs and lows are data, not instructions. Awareness precedes control, and control precedes consistency. Traders who ignore this stage often bounce from strategy to strategy, blaming markets, brokers, or luck, never realizing the root cause lies within. Those who embrace it emerge with a profound edge, the ability to remain calm in chaos, to follow rules despite temptation, and to treat every trade as an event rather than a validation of self-worth. In summary, the second stage of every trader's journey is the stage of overconfidence, emotional amplification, and self-confrontation. It is the crucible in which ego is tested, dopamine loops are challenged, and discipline begins to form. Survival here is non-negotiable for long-term profitability. Awareness, pausing, journaling, and strict adherence to rules become the tools of the trade. By mastering this stage, a trader gains more than skill. They gain mental fortitude, emotional intelligence, and a perspective that turns every market movement into opportunity rather than threat. This is the stage where the foundation of all future success is quietly laid, unseen by outsiders, yet felt profoundly by the trader who endures it. Stage 3 of every trader's journey is where the real test begins, the stage I call the emotional valley. If stage 2 taught you to pause, observe, and resist impulsive reactions, this stage puts that training to the ultimate test. The emotional valley is a place of prolonged uncertainty, repeated setbacks, and quiet frustration. It's the period where the market no longer hands you easy wins, where strategies you once trusted start to falter under real-world conditions, and where your patience, persistence, and mental resilience are stretched to their limits. Many traders, upon entering this stage, feel like they've hit a wall. They begin to doubt everything they've learned. They question the validity of their systems, the wisdom of their mentors, and even their own capability to succeed. It's common to think, maybe I'm just not cut out for this, or perhaps the market is rigged against me. But these thoughts are the exact test the market is imposing. The emotional valley is not punishment, it's a mirror. It reflects back the weaknesses still present within you: fear, greed, doubt, impatience, and lingering ego. Every trade that goes against you is not a failure of strategy, it is a revelation of your inner state. This is where mental fortitude begins to surpass technical knowledge as the primary determinant of success. In this stage, the balance between knowledge and action becomes crucial. You know what to do, your charts are clear, your plan is solid, but doing it consistently becomes the challenge. Each loss, each hesitation, each deviation from your plan is magnified in your mind, making it feel as though the market is actively conspiring against you. But the truth is simpler: the market is neutral. It doesn't judge, it doesn't care, it only exposes. And the emotional valley exposes one hard reality: success is not about controlling the market, it's about controlling yourself. At first, this stage feels isolating. Unlike the early phases, where excitement or overconfidence masks discomfort, here there is no dopamine to compensate for mistakes. The wins are smaller, the losses sting more, and the temptation to abandon your plan is constant. You might notice yourself overanalyzing, second-guessing setups, and obsessing over what went wrong. The mind begins to crave certainty where none exists. You want patterns to guarantee outcomes, you want strategies to promise profit, and you want control in a place inherently uncontrollable. This is the mental struggle at the heart of stage 3. Those who fail here often make one of two mistakes. They either overtrade in desperation, attempting to force results, or they freeze, paralyzed by fear and self-doubt, waiting for the perfect moment that never comes. Both paths lead to stagnation. The emotional valley demands a new skill: emotional endurance. It is the ability to act correctly despite discomfort, to execute your plan without guarantee of reward, and to maintain clarity when everything in your mind is screaming to react impulsively. Traders must learn to embrace the process, not the outcome. Each trade becomes a test of composure, each session an opportunity to reinforce discipline, and each loss a teacher rather than a punishment. Here, journaling, mindfulness, and self-reflection are not optional, they are essential. Every emotional reaction should be observed, understood, and documented. Ask yourself, why did I feel fear at that moment? Why did I chase that setup? Why did I close early or double down impulsively? These questions reveal patterns that money alone cannot. Slowly, the trader begins to internalize one fundamental truth: progress is measured internally, not externally. The account balance will fluctuate, the market will move unpredictably, and external validation may be scarce, but if you can maintain emotional neutrality and follow your plan, you are winning where it matters most: in your mind. In the emotional valley, the difference between a profitable trader and an amateur is clear. The amateur seeks comfort, the amateur chases results, the amateur reacts to every spike, every gap, every news headline. The professional learns to detect, to observe, and to act with deliberate patience. One of the most profound realizations in this stage is that trading is a reflection of life itself. The impatience, fear, and ego that surface on the charts are the same tendencies that manifest in relationships, career decisions, and personal goals. By mastering emotional control here, you are not just becoming a better trader, you are becoming a more disciplined, patient, and resilient human being. Stage 3 is where the foundation of long-term consistency is cemented. It is where you learn that the market is not your enemy, nor is it a tool to validate your intelligence. It is a mirror, showing you exactly who you are when under pressure. Every pattern, every setup, every candle is neutral. The response it provokes in you is the measure of your readiness. This is also where true patience is forged. You learn that missing a trade is often better than entering impulsively, that following the rules is more valuable than chasing a fleeting win, and that staying calm during drawdowns compounds your edge more than any strategy ever could. The emotional valley is demanding, but it is also incredibly educational. Here, mistakes are magnified and felt deeply, but each one teaches more than 100 textbook lessons. You begin to see the patterns not only on charts but in yourself. You notice recurring mistakes linked to fear, greed, or overconfidence. You learn to anticipate your own impulses and implement safeguards to prevent them from influencing trades, and gradually, something subtle begins to shift. The constant mental noise, the anxiety, the self-judgment, the frustration starts to quiet down. It doesn't happen overnight, but it happens persistently, like water slowly carving through rock. You begin to trust the process, trust your preparation, and trust yourself. This internal trust is the most valuable currency in trading. Once this trust solidifies, the market stops feeling personal. Losses no longer hurt as much, wins no longer excite as much, and the emotional roller coaster flattens into a steady, manageable rhythm. You start to notice that you are reacting less and thinking more. Your decisions become deliberate rather than impulsive, calculated rather than emotional. At this point, you are no longer chasing results, you are executing processes. Stage 3 also teaches humility. You learn that the market will always surprise you, that no system is perfect, and that no trade is guaranteed. This humility prevents overconfidence from creeping back in, ensuring that the lessons of earlier stages are reinforced rather than ignored. By the end of the emotional valley, you emerge fundamentally changed. You are more patient, more disciplined, and more resilient. You have experienced the depth of discomfort, confronted your impulses, and learned to act despite them. You have discovered that consistency is not a function of strategy or knowledge alone. It is a function of emotional control and mental clarity. Importantly, this stage transforms your relationship with risk. You no longer fear losses in the same way, nor do you over-leverage for the thrill of profit. Risk becomes a tool, not an enemy. You respect it, manage it, and allow it to guide your decisions rather than dictate them. Stage 3, therefore, is the crucible of character in trading. It is where ordinary traders are separated from professionals. It is where mental toughness is forged in the fire of repeated testing. And it is where the seeds of consistency, patience, and process-oriented trading are planted. Without this stage, all technical knowledge remains inert, all strategies remain fragile, and all ambitions remain dreams. But with it, you gain the most powerful edge in the market, the ability to act with discipline, clarity, and calm in the face of uncertainty. By the time a trader navigates the emotional valley successfully, they are ready for stage 4, the refinement of edge, where strategies are fine-tuned, risk management becomes precise, and every decision is backed by both analysis and psychological stability. Stage 3 is grueling, invisible to outsiders, and deeply personal. It doesn't provide instant gratification, nor does it deliver dramatic breakthroughs, but its value is immeasurable. Here, the trader learns that the real journey is internal. The growth you achieve in emotional resilience, mental clarity, and self-discipline during this stage will dictate your long-term success far more than any system, indicator, or pattern ever could. The emotional valley teaches that the market is not a battlefield to conquer, but a teacher to learn from. It teaches that every impulse you resist, every emotional reaction you observe, every deliberate pause you take compounds your edge over time. It teaches that profits are transient, but mental mastery is permanent. By the time this stage concludes, the trader no longer fears uncertainty. They welcome it as an opportunity to test discipline. They no longer chase profit, they pursue process. They no longer react, they respond. And it is in this space, calm, reflective, disciplined, that real profitability begins to emerge. The emotional valley is, without exaggeration, the most defining stage in the trader's journey. Survival here is non-negotiable. Mastery begins here, and those who endure it discover something profound. The market is a mirror, losses are teachers, and emotional control is the edge that no strategy can replace. Every professional trader you admire has walked this valley, stumbled, endured, and emerged stronger. And so will you, if you understand that this stage is not a barrier, but the gateway to everything that follows. Stage 4 of every trader's journey is the refinement of edge, the point where the lessons from the emotional valley begin to converge with real-world strategy. By now, you have endured uncertainty, resisted impulsive reactions, and built a foundation of emotional control. The market no longer triggers panic, greed, or ego in the same way, and your reactions are deliberate rather than automatic. But emotional control alone is not enough. Discipline gives you the framework, but refinement gives you precision. This stage is about transforming raw skill into consistent execution, transforming knowledge into an edge that can be reliably repeated over time. Refinement begins with a deep evaluation of your own trading behavior. Every trade you've taken, every success, every failure, and every emotional reaction becomes a data point to analyze. You don't just look at profit and loss, you look at the process. Did you follow your plan exactly? Did you stick to your risk management rules? Did you enter impulsively or with confirmation? Did fear or greed affect your decision at any point? This self-review process is not optional, it is the crucible of refinement. Here, journaling becomes sacred. You record every detail, not for bragging rights, but for insight. And insight, when acted upon, is what converts experience into an edge. As you analyze, patterns emerge, not just in the market, but in yourself. You begin to notice the setups where you consistently hesitate or the conditions that trigger impulsive exits. You start seeing which risk levels provoke emotional compromise and which strategies align naturally with your psychology. This stage teaches the invaluable lesson that trading systems are not one size fits all. Two traders could follow the same strategy and achieve vastly different outcomes, not because of technical proficiency, but because of behavioral alignment. Refinement of edge is about matching strategy to psychology, aligning rules to temperament, and creating a system that complements your strengths while mitigating your weaknesses. With this alignment comes confidence, not blind confidence, but calm, methodical confidence. You no longer question every tick of the market, you trust your preparation. You no longer chase setups to compensate for past mistakes, you wait for conditions to be perfect according to your rules. And with that trust comes freedom. Stage 4 also introduces a heightened focus on risk management, not as a theoretical concept, but as a practical, tactical discipline. Emotional control has shown you that losses are inevitable and unavoidable, but refinement teaches you how to protect your capital without compromising your edge. You learn to size positions precisely, to place stops strategically, and to plan trades in a way that maximizes potential while minimizing unnecessary exposure. Risk becomes your ally, not your enemy. You no longer fear a drawdown because you know it is a natural part of the process. Every loss is accounted for, every gain is earned deliberately, and every decision is made with intention rather than reaction. In this stage, traders begin to notice subtle improvements in execution. Entries become cleaner, exits more precise, and holding periods more disciplined. You start thinking several steps ahead, not in terms of predicting the market, but in terms of preparing for scenarios and reacting optimally when they occur. This is where the gap between amateur and professional truly widens. While amateurs react to outcomes, professionals respond to plans. Refinement of edge also teaches patience in an advanced way. You learn to wait not just for confirmation of setups, but for the optimal confluence of conditions. You no longer take trades to satisfy boredom or emotion. You no longer fear missing an opportunity because you understand that the market always presents the next one. Every entry is deliberate, every exit calculated, and every pause between trades a conscious decision to avoid unnecessary risk. One of the most subtle but powerful changes in this stage is the understanding of mental leverage. Your mental state now amplifies your technical edge. When calm and focused, your strategy works better. When distracted or stressed, even a perfect system can fail. So you begin to protect your mindset as fiercely as your capital. Sleep, nutrition, exercise, and mental habits become part of the trading system. You begin to understand that trading is not confined to the charts, it is a holistic practice. This stage also exposes hidden weaknesses that survive the emotional valley. Perhaps you are patient in winning trades but impulsive in losses. Perhaps you follow your plan but become rigid and fail to adapt when conditions change. Refinement is about identifying these blind spots and correcting them. Every adaptation strengthens the overall system and reduces the probability of repeated mistakes. The refinement of edge is iterative. You will make mistakes and you will fail, but the difference now is that failure becomes a stepping stone rather than a setback. You review, adapt, and integrate the lessons seamlessly into your next trades. The process compounds mentally, emotionally, and strategically. By the end of this stage, traders start seeing a profound shift in consistency. Trades executed according to plan become the norm rather than the exception. Losses no longer trigger emotional reactions. Wins no longer inflate confidence irrationally. Results fluctuate as the market will always fluctuate, but your process remains steadfast. This is the stage where strategy and psychology fuse into synergy. Your edge is no longer theoretical, it is operational. Every trade you take is an expression of mastery, of alignment between mental state, plan, and execution. Stage 4 also brings a more sophisticated understanding of market context. You begin to see patterns not just as isolated setups, but as part of larger trends, cycles, and behaviors. You learn to adapt your edge to different market conditions without abandoning core principles. Flexibility and discipline coexist. You also begin to notice how subtly different traders approach similar markets. You start benchmarking yourself not against results, but against adherence to process and emotional control. The comparison is no longer about who made more money, but who maintained discipline and clarity under pressure. This stage teaches humility in a unique way. Refinement of edge reinforces that no matter how proficient you become, the market remains unpredictable. Overconfidence can undo months of disciplined growth, so constant vigilance is required. The professional remains alert, adaptive, and humble, even as execution becomes smoother and more consistent. By the time this stage concludes, you possess a clear, repeatable system that aligns with both your skills and your psychology. Execution is precise, risk is managed intelligently, and emotional control is robust. You are no longer reacting to trades, you are responding strategically. You no longer fear loss, you prepare for it. You no longer chase opportunity, you wait for it. The transformation is profound because the trader you are now is fundamentally different from the one who entered stage 1. Your mindset has matured, your edge has solidified, and your process has become your greatest asset. At this point, consistency is no longer aspirational, it is achievable. You have built a system where risk, discipline, patience, and emotional control converge into repeatable performance. Stage 4 sets the stage for the final 2 phases, scaling and mastery, where every decision is fine-tuned for long-term sustainability, and where the compounding of skill, process, and mindset begins to manifest financially. Without this stage, scaling becomes reckless, and mastery remains theoretical. With it, however, you are equipped with the tools to execute reliably, adapt gracefully, and thrive in any market condition. The refinement of edge is where strategy meets psychology, where knowledge meets discipline, and where skill transforms into performance. It is the bridge between surviving the emotional storm and thriving in the market. And it is in this bridge that every trader discovers the true essence of professional trading. Process over outcome, discipline over impulsivity, preparation over prediction, and control over reaction. By embracing this stage fully, you gain not just the ability to trade consistently, but the confidence to trust yourself under pressure, the patience to wait for the right moment, and the clarity to act decisively when opportunity arises. The professional trader emerges not just by winning trades, but by consistently executing a process designed to withstand uncertainty, absorb losses, and capitalize on high probability setups. Stage 4 is where the trader stops chasing illusions of instant profit and begins to build lasting, compounding skill. And the reward for mastering this stage is profound: the ability to navigate the markets with calm, deliberate precision, to maintain mental clarity under pressure, and to execute a plan with unwavering confidence. This is the stage where your edge becomes a living, breathing system, dynamic, resilient, and uniquely aligned with your own psychology. Success is no longer dependent on luck or emotion. It is the natural consequence of preparation, discipline, and refinement. And as you move forward into the scaling and mastery stages, everything you learned here compounds exponentially. Each decision, each trade, each session builds upon the last, creating momentum that is both financial and psychological. By the end of stage 4, you are no longer a trader reacting to the market. You are a trader shaping your own performance, fully in control of your mind, your process, and your edge, ready for the next level of professional growth. Every trader dreams of scaling, of growing the account, the size, the confidence. But few ever get there, not because the strategy fails, not because the market changes, but because they do. Scaling isn't just adding zeros, it's adding stability. It's learning how to carry weight, emotional, financial, and psychological, without collapsing under pressure. Because the higher you climb, the thinner the air gets. When you start, every trade feels small, harmless. You can lose, you can laugh it off, you can try again. But the moment you scale up, everything changes. A 10 loss turns into 1,000. A small drawdown becomes a psychological storm. Your system stays the same, but you start shaking. And that's when you realize scaling isn't a financial step, it's an identity shift. Scaling tests your emotional ceiling. It exposes what you truly believe about money, control, and fear. Because trading bigger doesn't create new problems. It amplifies the ones you've ignored. So the first rule of scaling is simple. Don't scale your position size until you've scaled your emotional tolerance. If your risk feels like a threat, you will unconsciously sabotage your trade. You'll move stops. You'll take profits too early. You'll check charts every 2 seconds. You'll turn your edge into noise. Because your nervous system can't handle the heat. The real pros scale by desensitization. They grow slow. They increase size only after the old size feels boring. They don't chase adrenaline. They chase stability. If your trades still make your heart race, you're not ready to scale. Because professional trading isn't about excitement. It's about execution. Risk management, then, isn't a constraint. It's a freedom mechanism. It frees you from emotional chaos. It protects your longevity. It's the structure that allows creativity, confidence, and clarity to exist. Think of risk management as oxygen. You don't notice it when it's there, but you suffocate the moment it's gone. Every professional trader knows this truth. The goal isn't to make money fast. It's to stay in the game, because survival creates opportunities. If you survive long enough, you'll eventually be in sync with the market cycle that fits your style. But if you blow up early, you'll never see that moment. Your risk rules are your life support. They define how you think, how you act, how you recover. They protect your future from your present impulses. Livermore once said, "A speculator's capital is his courage." But what most people miss is that courage isn't about taking risk, it's about containing it. So, let's strip away the illusions and talk like a pro. Here's the hard structure behind professional consistency. Every professional has a fixed maximum risk per trade, not negotiable, not emotional, not situational, usually 1% or less of total capital. Because one trade should never have the power to end your career. That number isn't random. It's the psychological line between calm and chaos. If your position size crosses that line, you stop thinking and start reacting. They also have a max daily loss limit. If that's hit, the day is over. No revenge. No, just one more. Why? Because consistency doesn't come from fighting your emotions. It comes from designing around them. Pros don't hope for consistency. They engineer it. They follow checklists, pre-trade, in trade, and post-trade. They treat trading like flying a plane. Every decision has a protocol because uncertainty is always waiting to sneak in. A pro doesn't ask, "What do I feel like doing?" They ask, "What does my process tell me to do?" Because they know emotions are temporary, but discipline is scalable. The amateur tries to control the outcome, the professional controls the variables. They build systems that protect them from impulsive decisions. They understand that mastery isn't about predicting markets. It's about managing yourself in them. They know that the markets don't take traders' money. Traders give it away through poor risk control. That's why their recovery system is sacred. Loss is inevitable, but how you recover determines your survival curve. The amateur sees a loss as a personal failure. The pro sees it as market tuition. If a pro breaks their rule, they step back immediately. They review data, identify the emotional trigger, and isolate the mistake before trading again. No justification, no ego, no revenge, because they know rule breaking is the first symptom of emotional drift, and emotional drift destroys consistency. True consistency doesn't come from winning streaks. It comes from emotional equilibrium, the ability to remain unchanged whether you win or lose. Because when your identity isn't attached to your results, your process stays pure. Scaling that state of mind is the real challenge. Anyone can make 100 trades with discipline. Few can trade on 10,000 with the same emotional silence. So, scaling isn't about capital. It's about capacity. Your capacity to stay calm under larger numbers. Your capacity to execute when your stomach flips. Your capacity to stay aligned when your mind wants to panic. You grow into that capacity, not by chasing it, but by conditioning for it. The pros build emotional conditioning routines, breath control, pre-trade visualization, daily reviews, and journaling. Not because they're trying to be spiritual, but because they know calmness is a performance edge. In the professional world, mindset isn't a bonus. It's part of the operating system. You can't scale without upgrading the system that runs the trader. Professional consistency is built on one law. Remove uncertainty where you can control it, accept uncertainty where you can't. That's the balance. The pro knows the market is chaotic, but their process is not. They can't predict the next candle, but they can predict their next move. They can't control profit, but they can control exposure. They can't control the outcome, but they can control behavior, and that's enough. Because in the long run, behavior compounds faster than skill. It becomes an identity. The pro no longer needs to force discipline. They are disciplined. Their decisions are automatic. Their emotions are regulated. Their plan is sacred. That's what professional consistency looks like. Not perfection, but predictability. Not chasing profit, but defending structure. They view risk as a currency, something to be spent wisely, not avoided. They know every risk unit invested must have purpose, edge, and alignment. If it doesn't, it's noise. That's why they treat boredom as progress. Because boredom means routine is working. The amateur seeks excitement. The professional seeks repetition. Every trade is part of a larger story, not a single act of luck. Scaling through that lens becomes mechanical. The size grows, but the emotion doesn't. The account grows, but the mindset stays level. The system evolves, but the principles stay unchanged. That's the paradox. To grow, you must remain still. When your equity curve goes up, but your heartbeat stays calm, that's when you've arrived. The secret most don't see is this: risk management isn't just a set of rules. It's emotional architecture. It shapes how you experience trading. It defines how much uncertainty your nervous system can safely process. Without it, you drown in overexposure. With it, you flow. Because when your downside is controlled, your upside expands naturally. The mind becomes creative, not reactive. You see the market, not your fears. That's the foundation of scaling. Emotional neutrality through structural safety. And that's the bridge between amateur inconsistency and professional control. A professional trader doesn't just manage trades, they manage state. Because state management is risk management. Every day begins with the same ritual: check the rules, align the mind, prepare the system. Every night ends with review, not of profit, but of process integrity. Did I follow my plan? Did I act from structure or from impulse? That question defines your future equity curve. Professional consistency is built from boring repetition, done brilliantly. It's what separates the gamblers from the operators. Because a professional trader doesn't need motivation. They need alignment. They don't need adrenaline. They need calm. They don't chase the high of winning. They pursue the satisfaction of execution. That's why scaling and risk management are inseparable. One is expansion, the other is protection. Together, they create sustainable power. You can't scale what you can't protect, and you can't protect what you don't respect. That's why true scaling begins when you respect risk, not fear it. You see it as a tool, a teacher, a mirror. It shows you where your emotional ceiling still exists. Every time you scale, that ceiling gets tested, and every test reveals a new layer of your mindset. The amateur fights that feeling. The professional studies it. They understand that emotional pain isn't a signal to stop. It's feedback to grow. You expand by sitting calmly inside discomfort, by proving to your mind that you can handle more pressure without losing clarity. That's scaling in its purest form, not adding size, but expanding capacity. The professional trader doesn't chase growth, they grow into it. And that's the real game. You don't scale your account. You scale yourself. When you finally master that, consistency becomes effortless, risk becomes elegant, and scaling becomes a natural consequence, not a struggle. That's when you stop trading for money and start trading for mastery. Because the moment you start protecting your edge like your oxygen, that's when you've truly become a professional.